back to Risk to Reward. Today we're diving into VNET Group, formerly 21 VNET, a data center company with one of the lowest share prices in the industry. Trading around $6 per share, it's a stark contrast to giants like Equinix at $800 or Digital Realty $160. Is this affordable data center stock a hidden gem or a risky bet? Let's break down the bull and bear cases, review its earnings, and see how it stacks up. VNET is the largest private carrier-neutral data center provider in China, operating dozens of facilities. It's even the exclusive operator of Microsoft Azure and Office 365 cloud services in China, essentially running Microsoft's cloud platform behind the Great Firewall. This partnership with Microsoft gives VNET a steady stream of enterprise customers and credibility in the Chinese market. The company also hosts data centers for major firms like Alibaba, showcasing its big-name client base. In late 2024, the company announced new order wins totaling 252.5 megawatts from clients in cloud computing and autonomous driving sectors. This is a massive haul, indicating that hyperscalers and tech firms are choosing VNET's facilities to power everything from AI services to self-driving platforms. VNET's wholesale data center capacity jumped to 486 MW, up 127 MW in one quarter to keep up with these contracts, signaling strong customer trust and strategic expansion into high-performance data centers. Management expects surging demand for high-performance data centers thanks to AI developments. With AI models like China's DeepSeek requiring massive computing power, VNET is upgrading its infrastructure to capture this trend. They're forecasting 15 to 18% revenue growth for 2025, suggesting strong momentum. After years of heavy investment, VNET's finances are improving. In Q4 2024, revenue rose 18.3% year over year to $307.8 million, and the company reported a net profit for the full year till $25 million, reversing a previous loss. Gross margin improved to 22.5% from 15.3%, and adjusted EBITDA rose 19%, exceeding guidance. This financial momentum provides confidence that VNET's growth is becoming more sustainable. But VNET also faces serious risks. It competes with massive state-owned Chinese telecom firms like China Telecom and China Mobile, whose networks dwarf VNET's and are backed by vast resources. Moreover, cloud giants like Alibaba and Tencent often build their own data centers, cutting into third-party demand. Morningstar warns that VNET's facilities are not significantly differentiated, and customers could bring infrastructure in-house. VNET has also aggressively expanded, taking on large debt and recently repurchasing $600 million in notes. While new contracts are promising, construction costs are high, and rising rates are slowing demand could strain finances. China-specific risks add further uncertainty from regulatory crackdowns to US-China tensions and ADR compliance. VNET stock has been highly volatile, surging hundreds of percent in 12 months, but prone to sharp drops. Its retail colocation segment has seen declines as it pivots to wholesale. That transition brings execution risk, lost clients, underutilized space, or delayed construction could all hurt margins. In 2024, revenue hit $1.13 billion, with Q4's 18% growth driven by a 125% YoY jump in wholesale revenue. The company is guiding to $1.3 billion revenue and 2.7 billion yen EBITDA in 2025, showing continued confidence. Profitability remains thin but improving. Operating cash flow in Q1 2024 was 268 million yen, though CapEx remains high. Management believes demand for high-performance infrastructure will exceed supply by 2025 to 26, which could benefit VNET. In summary, VNET is a classic risk-to-reward play. On the positive side, it's a strategic AI and cloud partner with improving financials and big-name customers. On the negative side, it's a speculative, high-volatility stock facing major competition, debt, and geopolitical exposure. If execution continues to improve, this low-price stock could deliver strong returns. If not, the risks could outweigh the reward. As always, do your research and manage your exposure wisely. If you found this deep dive helpful, be sure to subscribe to Risk to Reward for more insightful stock analysis. Together, let's navigate the markets with open eyes and smart strategies.